Cremé Wealth Management, we come with no pretense. Financial advising, making money make sense.
Well, good afternoon. Thanks for joining me today. Just wanted to take the time to talk about a few things that people have brought up to me and some questions I've got around gold investing, for example, cryptocurrency, as well as inflation, what we're looking at today, and what the future might look like as well. So just wanted to go through that for the next 30 to 45 minutes here. And I'll be following up with any questions that you have that you can email or send me, and I will respond directly. So if we look today, there is a bit of a scary reality that is facing us when we think about everything that's going on. So the national debt situation, we have $29 trillion in debt. Our current inflation rate, as of the moment where I put this presentation together, was at 5.37% for inflation rate. The average home price up 16% in 1 year from 2020. And, they're saying now that housing is becoming more and more unaffordable. And then we have things like Bitcoin, whose market cap, the size of Bitcoin, is $850 billion. So that's the approximate size of Facebook and the fifth largest company in the world. And that's just Bitcoin. So wanted to kind of talk through these things and give us some perspective. And when we face scary realities, we always say we want to approach those scary situations and shine a light on it and hopefully be the light in the situation. So that's what we're going to try to accomplish today. So JP Morgan, this is the person, not the company, said gold and silver are money. Everything else is credit. And I think that's pretty much sums up his view on how the credit system was evolving at the time, being in the banking and finance space. So we're going to start with talking about gold. So the gold price, since I just took a snapshot of 1915 through 2021. Gold in 1915 was $19.25 per ounce. And as of today, give or take a week or two, the current price was $1,751.20 per ounce. So it has gone up quite a bit, as we'd expect over 100 years worth of time. There are still some current applications for gold outside of just jewelry, such as smartphones and limited use in GPS devices. Some of the interesting things I found when looking into it was the gold standard was dropped by the U.S. in 1933, and we see this big jump during that time frame where it kind of looks like a cliff on the slide. So in 1934, part of the efforts to recover from the Depression, the U.S. decided to pay more for gold than it was worth to try to stimulate the economy and bring dollars into the U.S. So they actually said, we're going to pay $35 an ounce, even though it's only worth 20. And that's why we get that immediate jump, which actually helped when we look in the rearview mirror, it helped make the U.S. currency the default currency of business in the world, because so many countries were coming and saying, yeah, we'll buy some of that. Here's our gold. We'll take some of your currency. So that's the picture when we look at gold and how it's done. You see it's had that jump in 1934, and then it was pretty much flat for years upon years. And then it really spiked in the 70s once inflation took hold. So inflation is often talked about when it comes to gold, and they kind of correlate according to some people. So I said, well, what if we took the gold price and said, well, how was gold doing in light of inflation? So the next view here is the same time period and just saying, what was the gold price inflation adjusted? So as we'd expect, that first period of time where gold was pretty much doing nothing, well, inflation was going up. So because inflation was going up, gold is going down. So we see that, gold price dropping down there. The jump in the price back, if we look here, that's where that 1934 bump in price took place. Again, a flat period of time or a negative period of time, gold price goes up and then down. And then we have this spike here, as we'll look at specifically in the 70s. And then again in 2000 on, we had another period of time where gold goes up. So there's some arguments for gold, and anyone who's selling gold, you're going to hear, these arguments when you're turning on the TV or listening to the radio. So gold argument number one is it can be a hedge during depression or times of recession. So what this chart will show you is the gray bars. So if you see the background, all these vertical bars, these are all times where the GDP had two negative periods of time or was defined as a recession by the US standards like we just had. And any of those we'll see, here's the recession period and how did gold do during those? Well, just looking at it, we see most of the time there is not a jump upward during those gray bars. We often have a time where gold is going down during those gray bars, and then it could go up afterwards, potentially depending on the time frame. So I would say just the pure argument of it's a hedge during a depression or a recession, I don't think it holds water just from looking at the math behind it. The other argument that people sometimes make around gold is saying, well, if the world falls apart, we can go back to the gold standard. There isn't enough gold to go back to the gold standard. And if we try to go back to a barter system based on gold, it would be very difficult because a gold coin, as we saw that, an ounce is over $1,000 just for an ounce of gold. You have to buy a lot of goods every time you spend one coin, or we're getting back to the olden times of carrying around scales where we have to literally weigh the metal to determine the value. I don't think that would necessarily happen. And I'd say if you think that the world's going to fall apart, you're probably better off investing in seeds and bullets and guns. So probably not the going back to the gold standard and bartering with gold anytime soon. And then the last thing, and this is the big one that comes up these days, is, well, is gold a good hedge against inflation? So we want to look at periods of time where there's inflation to say, how's it doing? How did it hold up? And the biggest period of inflation started for our country, the biggest 10-year period in the last 50 years, started in 1973. So we're going to go take a snapshot and just say, how did it do in 1973 to 1982? And here we have the gold price in the highest 10-year inflation period with an inflation adjusted price. So that price is going up, countering the inflation that's going on. The low inflation rate of this period of time was 3.83% in a given year. The high was 13.29%, and the average inflation was 8.71. So if you owned gold going into 1973 and owned 1 ounce, it was approximately valued at $400. That gold at the end of the time frame, the 10 years, was, as we see on the chart, just shy of $1,200. So gold basically went up by 300% over this 10-year period, or just shy of 30% average return per year, with some years having a higher percentage as well. So if you just looked at this picture, you'd say, well, gold is a pretty good hedge against inflation, according to history. But the problem with that is gold is where people seek refuge or sought refuge in the 70s against inflation, because there was nowhere else to go. But now there is something else, a new player that's on the scene. So just kind of shifting to the next topic is, digital currencies and cryptocurrencies. So just to clarify, so what is a digital currency? So we talk about digital versus crypto. I want to explain that for people that are new to that or just quite don't understand it. So a digital currency is just currency that is performed online. So there's a transaction or a purchase, and that purchase, there's a notification of to the bank that, hey, there's been an exchange of money. We need to, exchange that to become whole on our end. There's a central server for the bank that records the balances, just like when we log into our bank account or Chase account or Raymond James account, it's right there. And there's a lot of cybersecurity to protect that central server. So in the case of Raymond James, we have lots and lots of rooms filled with just security to protect data as it's constantly under attack. And that's the same with every bank. So there's a central server, lots of security, and then some backups on top of backups to make sure that should something happen, they can restore everything. But the main key about overall digital currency is when you swipe your credit card or use your bank, it's all tied to the US dollar. And that's where cryptocurrency kind of deviates a little bit, is it's not this standardized process. What it is it uses something called blockchain technology. So if you think of it this way, it's a lot of tiny servers that are all pinging one another and explaining what value exists. So it's not a centralized server. So there's no, cybersecurity needed in the same way, because if you have 100,000 servers that are all identically verifying the data to one another, it's harder to hack a single server and change that data, because the other servers will say, no, that's not correct. We're going to ignore that abnormality. So that's the idea behind blockchain, is it's just a mesh networking matrix-based system, and it's not tied to the US dollar. So Bitcoin is no different than buying a Mexican peso if Mexico didn't exist, if you think of it that way. So it's a currency for a country that doesn't exist. So it's digital, and it's a cryptocurrency as well, because it's not tied to any country's denomination. So cryptocurrency is now in some ways the new gold. It is where people have put their money when they're afraid of what's going on. And because of that, gold and crypto are very much part of the same conversation when people talk about inflation and where to be when we're thinking about hedging. So if we just take Bitcoin, for example, because that's one of the most well-known cryptocurrencies, and say, well, how is Bitcoin done historically? So if we go back to 2013, Bitcoin's price was somewhere, it started very low. It started pennies. It hovered at about $100 to $150 for years. And then we see the traction that kind of took off starting in 2017. It peaked in 2018 to almost 20,000, came back down. And in 2020, March 16th, so right as COVID was kind of being announced and taken off, the price went down to 5,000 for a single Bitcoin. And since then, it has now marched on. The high price it got to was almost 65,000 about a year later, in April 13th. Currently, it says here about 44,000. I think it's 46. It kind of depends on the day. So right around there. So that's a huge return. And sometimes people say, well, Bitcoin's just taken off. And that's true. But if you got in at the wrong time, you could still lose a lot. And in 2018, the return for Bitcoin was negative 72%. So that's a year when the markets were also down, but not down 72%, right? Down more like 10%. Is a little bit different. So Bitcoin's emergence on the scene really does change things for gold, because this is where people have been putting their money. not as much gold these days. And I think it's gotten a lot more press that gold just isn't doing what gold did historically. So every prospectus will say you cannot look at historical numbers to project the future. And that's certainly the case, I'd say, for gold, just because of Bitcoin and cryptocurrencies in general. And I put down some personal thoughts just on crypto in general to say, and this is coming from someone who really thought it had something special to begin with and has maybe gone sideways a little bit recently. But basically, it's extremely volatile. It is so volatile that it's unregulated, and we really can't count on it to be there. It might go up and it might be great, but to me, it is not that different than going to the casino and putting your money on, Black 24. It may take off, it may not. It's just really hard to know. There's a lot of potential there, as the idea was crypto was going to basically revolutionize digital transactions, is what I remember when it first came on board. And they'd say, hey, every time you swipe your credit card, Visa or MasterCard, they're making 1.5%. And we're going to create this currency that's completely digital that has zero transaction fees. And it really made a big impact to people that worked in one country and they were trying to send money home to their former country, to their family. And it would get around TransUnion and other things that are still being utilized right now as people send money orders or wires. And it would all be transaction free because that's where that currency lives, is digitally. And the problem is that the IRS saw all the money going into this and suddenly said, whoa, cryptocurrency is not a currency, it's a commodity, which is a big difference. Because if I bought 1,000 pesos to go to Mexico for a trip, and during the time I was in Mexico, the value of the peso doubles, and I come back home and I take my pesos and I exchange it for US dollars, that exchange doesn't create a tax burden. It's just currency, changes based on, I had this, I'm changing it for the value today. Once it's a commodity, that exchange now becomes a taxable transaction, where the IRS says, wait, you bought at this price, doesn't matter if you're exchanging it for another currency, that's a taxable transaction and you haven't held it for at least a year. So that's a short-term gains tax, and we're going to ask you to pay ordinary income taxes on the profit that you made. So that happened during the last 3-4 years or so, and that really changed the outlook of the applications for cryptocurrency. So because of that, it's becoming harder to picture how it's being monetized. And there are some very high profile people out there, with Warren Buffett being one of them, that have pretty much said that cryptocurrency now is a giant bubble and it's just waiting to burst because it has no application. So, and that's the currency itself, not the technology. Most people will argue that Bitcoin has merit, matrix-based blockchain technology has merit, but the currency itself, it's going to be a hard sell. So that's one piece of it. The other piece is, even though it's a matrix-based blockchain technology, it still gets hacked. And people lose money. In fact, someone just hacked last month in August and stole $600 million from Bitcoin from one of the holders and record keepers of it. And I believe that most of it was since returned, and they were maybe making a point, but this wasn't an isolated incident. So it is not necessarily secure. There's no FDIC insurance in that sense. So there's risk there, just in a, will you open your account and see a zero balance because a hacker figured out how to do this in Indonesia. So The other piece is governments are, looking to regulate it further and further now that it's already a regulated commodity. So there are countries that are banning it. There are lots of things going on. So there's so much that could happen immediately to change the price that's why there's high risk, which may result in higher reward in price, but it may just be high risk. A lot of times people like cryptocurrency because it wasn't regulated, because it was a place to put money, and the government's onto that, and they're definitely making that harder, and probably going to be auditing more people that have accounts there. So as I mentioned before, it's also modern day gold. It is where people are putting their money that have concerns about the US dollar, the government, things like that. And because of that, it is being inflated artificially in some ways and has no backing. So there may be growth, there may be some gains to be had in investing in it. But again, it's just speculative, and there's nothing to fall back on at all. The last point I'll make on cryptocurrency is just Bitcoin's always the big name that people talk about, but to date, there are actually 4,000 cryptocurrencies. And it's so rampant that I was watching a video the other day, and it talks about how people are getting suckered into, investing into scam coin, and they have all these types of names that are coming out. And suddenly, oh, sorry, it went to zero, but we've got a new opportunity. So it is becoming a little out of control in the crypto arena, whether or not Bitcoin itself or some of the other ones like Litecoin are doing things more conservatively. I don't know the right terminology on that. So moving forward, talking about inflation. So all these are in conversations around, does gold or does cryptocurrency help to combat inflation, rising inflation rates? So, well, what is inflation? Well, inflation, as my old economics professor would say, is too many dollars chasing too few goods. So we changed it to too much money chasing too few goods. This is basically when the consumer-driven inflation happens, and that's what's going on right now. There's more dollars in the market, right? The government has been sending us checks. We've been getting low interest rates. We've been having the government buy treasuries through quantitative easing and push money into the general circulation. So all these things are going to cause inflation to go up, as we're seeing. So how does this look from a practical standpoint? Well, here's an example of Cokes. And if you say there was 100 Cokes that are sold to a market, and that particular market says, well, we have $100 allocated to buy said 100 Cokes, the price of the Coke is $1. But when the same 100 Cokes is allocated to a market that now has had more money pushed into it, and now there's not $100 in that market, there's $105. Each Coke now costs $1.05, or 5% inflation has occurred. And that's really what we're going through now, is it's the effects of this money being pushed into the system. So if we look at inflation rates and take into consideration that first worst 10-year period from 1972 or actually 1973 to 1982, but you'll see this wide roller coaster range of rampant inflation for 10 years. And then the government really has done a pretty good job of cracking down and saying, we're going to be very purposeful in trying to keep inflation at a 2% rate of return, or a 2% rate, as the GDP is aimed at around the same number. And it's been pretty close. They've done a pretty good job of keeping it that way. But as you see, as of late, 2020, 2021, we've had that spike up where it's now approaching 6%, which is a little bit higher than we're used to having over the last 30 years. So what does this kind of look like when we take inflation and say, well, where should we be investing or putting money given inflation? What are what are the categories or what are my choices? And the start, we're going to look at the worst inflation time frame, that 10 years, go back to that, because what I always want to say, what's the worst case scenario? So 1972, well, we'll look at the full picture first. So 1972 to 2021, we have large, mid-size, and small U.S. companies that are all represented here. We have a 10-year treasury note to represent fixed income, and then gold. So the inflation, when we take the really high inflation rate time frame and average out the whole rest of the period, inflation was about 3.91% during this, but large U.S. companies have averaged over 12%. The mid-sized company space was at 13.82 and small 13.91. And treasury notes averaged over that time frame 7.4%. Gold has done pretty well at 10.36 when we take into consideration the 30% returns it was averaging between 1973 and 1982. And if we look at that 10-year specific section, you'll see that exact. So gold, 29.39% average return versus inflation of 8.71% during those 10 years. But how did regular equities and stock market do? How did the treasuries do during that time? Well, you got anywhere between 8 and 19%, rates of return just being in the stock market, and bonds were 7%. Now, obviously, rates where we're at today are not that, but this is a different time, and inflation was much, much worse. If we break this down and say, well, how is this going each year? This really gives you the picture of inflation happening each year of 8.71, 12%, almost 7, 4.86, and how large cap companies, mid cap, small, were all doing during that time frame. And even the treasuries, how it was bouncing around in different percentages. Gold did come out looking pretty good. And if we said, hey, nothing has changed, if cryptocurrency was not a factor, would gold be a valid place to be right now? I think the answer is probably yes, but we're not in that situation. So kind of looking back, the question is, what is inflation doing today? Well, going back to look at this, we're approaching a 6% inflation rate. It may continue to go up. There's some conversation going on with the Fed that they're going to be easing off some of their stimulus. So we'll see if that helps to taper off the inflation that's occurred. But 1915 to 2021 gold prices, if we say, is gold a good hedge against inflation? Well, look at that last bar that's all the way on the far right. Well, that's where we're at today. And I think the answer there is that line is going down. It has not been a good hedge against inflation at all. So I think that the best answer there is, well, gold's not going to be the solution to get us out of inflation. So what questions should we be asking and what things should we be answering right now? So number one is inflation even a problem? And the answer is, maybe. It's done in a year-over-year analysis. So from 2020 to 2021, yes, prices are up. There's a lot more money in the economy and people are spending more. Things are costing more, especially if we look at things like used car prices. But some of that's a symptom of the supply chain having issues. And I wouldn't necessarily argue that that is going to continue on. But inflation can have some benefits, and there's definitely some arguments that the government will continue to allow inflation to run a little hot for a little while. And by hot, I mean, maybe 4% for an extended period of time. And that's for a few reasons. Number one is with inflation can mean that wages rise. So if everything costs more, we have to get paid more. And if we get paid more, well, what happens? The IRS gets paid more too. And we now have this giant $29 trillion national debt situation. That can be a pretty good reason to keep inflation going. The other thing that happens is with inflation, it helps to devalue the US currency. This is something that China's been doing for years. And in devaluing their currency, it means that other countries are more likely to invest because things are on sale relative to the strength of their currency. So inflation can have some benefits from a macro level perspective. When we look and say, can we trust history on this? As we saw last year, COVID does change things. So will the government stepping in and intervening change the whole conversation? It absolutely can. We really need to keep an eye on some of the regulation that might come out, because as we saw with some of the stimulus last year, small companies overall should do well in inflation, but not when the government is creating problems of giving loans to companies that end up being bigger companies. So small companies get penalized. Those are problems, and we just need to take that into consideration when thinking about the best places to be. And the other things, as I've been saying, is that cryptocurrencies are just so new. It has changed the landscape. We don't know what the future is going to necessarily look with them. It's definitely an argument on both sides that some will say it's a bubble about to burst. Others say there's practical applications. Both have valid points. So what are some of the key takeaways and things that we can definitely take to the bank and say, okay, that makes sense today, and it will make sense for the foreseeable future? So key takeaway number one, and just to make it clear, if inflation wasn't a concern, gold wouldn't be the answer. So if inflation wasn't on the table and we go back to that gold chart, it just doesn't compete compared to securities. If I can own a share of Amazon or an ounce of gold, I'm going to own Amazon all day long because it's going to outperform gold, and it doesn't give me a hedge against anything, but neither does gold. So that's not the answer. If inflation is a concern, gold may be the answer, but it's not. And the reason why is cryptocurrencies. It's just not the hedge. We're seeing gold prices tank where cryptocurrencies are going up. So there's definitely some correlation between the two, and it's just not the safe haven that people hope it will be. So number one, gold and cryptocurrencies are unpredictable in how they will perform. They might go up and you might laugh about it later on and say, hey, that was a great investment, or they might go down and you really kick yourself for missing out. So it's just unpredictable. That's all we can really say about both of them. Gold maybe used to have more predictability, but now less so. Key takeaway number two is, even when we look back to the 70s and say the worst inflation, almost 9% year over year for 10 years, even in that situation, the stock market can still potentially outperform inflation. In fact, when we compared the different asset classes, and you go back and say small, medium, large, well, which area did the best? It was actually small companies. So that area did better than the S&P 500, which would be represented by the large companies. So the stock market can still be the place to be. Don't be afraid to be in the market just because we're riding out some heavier inflation. So Warren Buffett has a great quote that says, only when the tide goes out do you discover who's been swimming naked. And I'll tell you, there is a lot of people swimming naked right now, owning the Dow Jones or S&P 500 exclusively. Their whole portfolio is just in that. And that would be my key takeaway number three, is there are other indexes other than the Dow Jones and S&P 500. You should be in them. So don't necessarily just go in the S&P because it has been the highest performing index since the housing crisis, which it has. But just know that that won't necessarily always be the case. you need to be adjustable in your philosophy and what you're in, and know that the S&P 500, while it has done well, also people forget that from 2001 to 2010, they consider that to be the lost decade, where the S&P 500 overall got zero as a return because it just went through the dot-com bubble and the housing crisis both. So that wouldn't have been the place to be. So it's not a guarantee place to park your money. And the key takeaway number 4 is that cash is king, and with inflation can bring opportunities to buy. Any situation where there's turmoil, and I'd consider high inflation turmoil, not that we're in high, but hypothetically, you may have the opportunity to buy in when there's a market correction and things go down by 10 or 15% because of a news article. If you have a reasonable amount of cash on the sidelines, and I would say, your situation, reasonable is different, but don't be all in cash, still be in the market, still be moving along in your investing, in your financial plan, but having some cash on the sidelines isn't a bad thing. So you have the ability to pounce and buy during those market changes. So those are my 4 pieces for today. If you have any questions that I didn't answer specifically in this, please feel free to reach out. You can send me an email, give me a call, a text, whatever works for you. And I'm happy to have a conversation about how your situation specifically applies to what we talked about here.